Hi, everyone. I'm Sophia Horowitz. I'm a partner at LW3. First of all, thank you, Blockworks, for having us today. It's been a great event so far the last couple of days. Hopefully, we can keep the energy up for this last panel on the main stage before the lunch break. So today, we are focusing on the allocator's perspective on digital assets. Over the past decade or so, digital assets has really moved from the fringes to becoming a legitimate part of the conversation in institutions. So I guess behind the scenes, it is always the allocators themselves when it comes to digital assets who have been making the decisions really on and managing kind of how this asset class will be legitimized. So looking at how it's valued, how it's sized, and managing its risks alongside traditional portfolios. So today, I'm very pleased that we have 3 allocators with us who really sit at the heart of making those decisions. We have Chris Solarz, who's CIO of Digital Assets at Amatus Capital. We have Pierre Henry, who is Head of Private Investments at XPAM. Have I said that right? And then we have Manish Singh, who is CIO at Crossbridge Capital. So for context, to get started, can we explain to everyone in the room a little bit about your current roles and also give us a bit of insight into how much of your time and your energy is spent on crypto? Let's start with Chris.
Sure. Hi, everyone. My name is Chris Solarz. I'm CIO of Amatus Capital Digital Assets. We are a digital assets fund of funds backed and seeded by a family office here in London. I invest in venture capital and also liquid strategies, including market neutral and directional. And I guess my history with digital assets goes back about 8 years. And I have been an allocator to hedge funds for 20 years now. And one thing I've always appreciated is alpha, is the skill of kind of eking out kind of that risk-free profit. And when I first saw cross-exchange arb, and in the early days, we were making triple-digit type returns, for me, I didn't have to buy into the fact that these were an emerging technology. Instead, I was just kind of enamored by the fact that there was real alpha to be had. So that was kind of my entree into digital assets, and I kind of joke that I came for the arbitrage and I stayed for the technology. So here I am today, and happy to be here.
Thanks, Chris.
Hi, so I'm Pierre. I work at XPAM. We are a fund of hedge funds. All we do is digital assets. And we're really a macro firm, so we think about the full cycle, the full business cycle, and invest in managers based off of that. There I'm Chief Commercial Officer and do our private investments. And I started with, in 2016, I was a business school student at Stanford, and we had all the technology coming through Palo Alto. So I learned about it there. I didn't really do anything. I had a traditional finance career before. And then when COVID happened, and like a fourth of all American dollars were printed in a month in history, like markets were closed, you say this isn't normal, you start looking at gold, real estate, Bitcoin, things that are fixed in quantity, and I went down the rabbit hole that way. And basically, we are very much looking at where to spend time, and when you look at how assets have performed relative to inflation and debasement, it's not as compelling, right? Anywhere else, you have exponential technology, you have digital assets, and so that got me fully down this career and industry. So.
Hi, I'm Manish Singh. I'm CIO at Crossbridge Capital. Most of what we do is on the traditional equity side. Unlike Chris and Pierre, we are making small steps into that direction of moving on digital side. We do get a lot of client query on what's happening in the digital business. So for me, how did I get into digital world? The old-fashioned way, first being a critic, not accepting it. I remember my friend Kelly, she mentioned to me to buy Bitcoin at $400. I didn't buy it. That was many years ago. Big mistake. So you learn from that. So we are seeing a lot of people on the traditional asset side who now understand that something new is being built up, and you need to be part of that. So we are not actively pushing it, but when we get more query, you have to be prepared to answer those questions.
And how are each of you thinking about digital assets in a broader macro and in a portfolio construction context right now? Should we start with Chris?
Yeah, sure. Well, maybe my favorite part about digital assets is the positive asymmetry and the positive skew and what it can add to portfolio from a portfolio construction concept. So I kind of start there, you know, and as a student of the markets and as someone who's built portfolios over the years, we would typically talk about gold having positive skew and trend following strategies as positive skew. And that's so complementary, kind of, it punches above its weight as an added component within a diversified portfolio. And of course that offsets emerging markets and credit, which have this negative skew. So I love digital assets for many reasons. One is that it has just, you know, tremendous upside potential, and two, that it's kind of more accretive per unit than anything else you can add to the portfolio right now.
Right, so again, we are a macro group. I have the privilege of working with a guy called Raoul Pal, who many of you will know every day. And our view is that this is one of the great exponential technologies of our lifetime. So the whole space, it's about 4 trillion. We say within, you know, probably by 2032, it'll be at 100 trillion. And you, again, if you look at where a global hurdle rate is for investment performance, which is to us this whole debasement trend and inflation, not a lot beats that. It's basically some parts of the NASDAQ and, you know, AI and this digital assets. So we actually think that this whole cycle is quite similar to 2017. And it's right translated, so basically it's extended. And so we think that you're going to see this debt maturity, which is now so famous in the US that the government cannot pay for, a huge amount, which is based off of a 5-year or less term structure, is going to mature, and it needs to be paid for. And so you're going to see monetization. You're going to see, we think, a recovery in the ISM above the level 50 over into 2026. And it's still a high beta play on global liquidity. That's what drives this asset class. So for us, that's firmly in place. And so we're positioned for that, and we think that these managers are the best way to express that view.
Yeah, I would add to what Chris mentioned. You know, there is a high optionality in what's going on, and you can't access that in the listed market. So you do have Coinbase or Circle IPO, and there are a few others coming up. But like anything, you know, people who came early in the railroad business, they went bankrupt, and now they build the whole world and whole economy around it. So you will have the skeptics, and you will have your gains and losses, but this is the great asymmetric opportunity you have, which you need to have access and have in the portfolio. So I see this as we are beyond the meme phase. Meme phase is over. This is more like a building phase, putting the plumbing down, building the infrastructure. So just like when you had the dot-com bubble burst in, everyone thought the internet was over. I mean, we have people like Paul Krugman who said internet is a fad. Look where we are today. So I think we are at a stage where the Googles and Amazons of this world are being built up, and you have to be part of that. And sometimes you do not get access to that in the listed market, as I said, but they will have a place in the portfolio. You see on the banking side, we had the bank earnings yesterday, and you heard Jamie Dimon and everyone else talk about what's going on. I believe that they will be running a much smaller enterprise. That doesn't mean the stocks are going to go down. I think banks are going to turn into tech company. They will get valued as a tech company. Not your 20, 25 PE, maybe 40, 50 PE, because they will have much more growth and earnings. So from a traditional point of view, I think you're coming where these things are going to merge and you're going to start looking at. So either you can get into it now through private business or fund for everything else, or you're going to buy that in listed market. You'll still do well because, you know, look at what happened to NVIDIA over the last 2 years, let alone for the last 5 years. So there's a huge asymmetric optionality of something being built, and you cannot ignore it.
All of us see and have spent time with probably hundreds, Chris, I think for you, and maybe for Pierre, it could be in the thousands of crypto managers over your careers. What I think everybody in here is probably interested to know, what are the most compelling, the most interesting things that these managers are focusing on right now that spark your interest?
No, this is a great question. And maybe I'll take it in 3 mini parts because I really see the crypto asset management universe in 3 different silos. So we have crypto market neutral, and we had probably the best stress test we've ever had over this weekend, and we're finding out a few that, that were wiped out, that were part of the 1.6 million trading accounts that were liquidated. So we really found out, as Warren Buffett says, when the tide goes out, who is swimming without a bathing suit. So risk management was very, very important. So look, the market neutral managers, the opportunity set is still there. I think right now, perhaps more than ever, more than 1 week ago, because the leverage is down. We've kind of been reset. And after these big storms, whoever is left with deployable capital is in a really good position going forward. So that's very exciting. I think within liquid directional, these are long biased, generally long biased token pickers. And what they're trying to do is to really outperform Bitcoin, outperform a long biased index. So they see a lot of different, their portfolios can really, really range. I think the most exciting thing there is finally, since the beginning of this year, since we had regulatory change in the US, we're seeing these managers really lean into tokens with real revenues, with real fundamentals. They can almost apply an equity-like discounted cash flow to future earnings. So we see, tokens, layer ones like Solana and Bitcoin, but tokens like Hyperliquid and Aerodrome and Maple Syrup that are really, cash flow positive. Like that is kind of what is the biggest theme I see there. And then in venture, I think venture has been a little bit tough on the asset raising. Because of the cycle that we've been in these last few years, we haven't seen a lot of DPI, and that's kind of a challenge, but it's just as exciting on the pre-seed and seed side because there's a lot of exciting things there being built for the future. So I see opportunity across all three verticals.
Yeah, I thought that was a great answer, and I echo a lot of that. I think that for the whole market cap of the space to get to 10 trillion, you need institutional investment, and it still hasn't really come. And what is going to compel those groups, it has to be real fundamentals that can be underwritten at an IC and withstand scrutiny over time. And so the protocols that were mentioned by Chris are great examples of that. Over the weekend, they often perform better than their centralized counterparts, which is, I think it's really compelling for people to say, I need to pay attention to this. In general, I think what I would add is the other big trend this year has been this DAT phenomenon. And basically, the market structure right now is that people can invest in Bitcoin and Ethereum through an ETF, and the wider ecosystem is still not really available. Some groups can't even, through their mandate, invest in spot or even the ETF. And so this was an opportunity to maybe form a bullish expression of a particular protocol. And I think that the largest ones have worked very well because they actually have been diligenced by these groups. And so again, it goes back to this idea that something needs to be familiar. You have to defend valuation with something like cash flow or some sort of sustained adoption that people can get comfortable with. As we see more of that, I think that you're going to see more and more participation. And some of these subscale DATs, if they're not having these commercial partnerships and announcements that lead to those things, I think it's going to be difficult over time. So, but echo what Chris said beyond that. Yeah.
Yeah, just to add to what Chris said, and the tide goes out a lot in crypto world. So you have to be very careful about who you're working with, as we saw on the weekend. But if you again look from the traditional equity background, if you look at the back offices of big banks, in trade settlement, in intermediation that they do, I mean, that is going to change a lot over time. And so DATs are a good example of what's happening, but then we heard from, I think, the rep from JP Morgan on the panel yesterday and other people what's happening. So to me, you are really addressing that part of the industry, the big part. Now, still, if you talk about the bond issuance on chain, which is still more like a PR thing than the real thing, because there's still a back office trying to reconcile what settlement has happened. So we really haven't seen the big move in it. So I still think that we are very early in what we are seeing. But you're going to see real use case in industry, real use case in banking. So you're seeing a new monetary framework is being built up. And while some people might be getting bullish on gold, but there's something else happening. And this is not your grandfather's gold. This is something else which is being built around. And you really need to be part and understand what's going on, or else you're going to get left out. And with a digital framework and decentralization and TradeFi and DeFi and everything that's happening, you have a real framework is being built in front of you, right in front of you, with new and big winners. So when I see projects of people are working on tokenizing unit assets, and if you look at the case of BlackRock and what they are looking to do with their fund business, real estate business, you really have a big future being built up. And this is coming from people who didn't believe in blockchain or didn't believe in these things. You can go and Google their videos from 2-3 years ago where they didn't believe in this. And then you have people like Peter Schiff. And I saw a video last night of a guy who was banging about blockchain when it was $4,000, and Peter Schiff was ridiculing him. And yes, Peter Schiff is right on gold, which is at $5,000, but look where Bitcoin has gone to at the same time. People are excited about silver has gone to all-time high. It took 40 years to go back to that all-time high. That's not how long it takes Bitcoin and everything else to go. So you can be skeptic and miss out on everything, or you can take an interest and learn. And this is where, given my equity background, I do a lot of structured equity trade. I see the optionality. I see a huge asymmetric optionality in what is being built around us.
Just touching on some of the points you made there, I guess, Manish. In 2024, last year, very few managers managed to outperform Bitcoin. How are you thinking about manager selection now? And it can't really necessarily be based entirely on track record, obviously.
Sure. So I always say it's easy to ride the bull market. You look for bears who can surf properly, not the bull market. Anyone can ride that, and we saw that. And it's also not about just 1 year, because 1 year can just be a matter of luck. What you really need is over cycles, because it's not about having an exposure. It's about sizing the trades. I say this to everyone all the time. You can copy my trade. I'll tell that to you, but you can't copy my conviction. You can't copy how I'm going to risk manage it. So when you're looking for managers, managed selection, don't go by just the track record of last year or the year before. You really have to understand the philosophy of how they look at investment, how they look at the world. To me, that is a big part of due diligence than somebody just beating because you got lucky on a trade or you had leverage on a trade. So you have to see over cycles when you're selecting a manager. I mean, we are not doing manager selection on digital side because we are not as big on it, so we are getting exposure in a different way. But if you are doing manager selection on digital side, to me, that would be the first thing. So everything that we have learned on the traditional asset side is going to stay. It's just that you're going to apply the same risk measure and mentality on the digital sides. But the philosophy doesn't change, how you look at risk or how you should size the trade. That should never change. And the people who use leverage on the weekend on a trade that already has a huge optionality found out what it does to you. Because there's already an option built in, so you already have a leverage. You don't need to go and lever again. So this fundamental understanding is very, very important of who's managing your money and who you're trusting your assets with.
Yeah, and maybe to add to that, I think it is true that many managers didn't seem to justify the 2 and 20 fees versus Bitcoin lately. But I think that first, you can totally have a barbell approach, right? Where you can have part of your portfolio in a Bitcoin where you're not paying a fee, you have liquidity, you have this blue chip growth, you're part of that. But you also have an actively managed piece of the barbell, whether it's 90-10, 80-20, it's up to the group to decide. But that can be in smaller cap tokens. And I think the understanding to add on to the discussion is that it's not just about security selection or token selection in these contexts. It's much more understanding the macro regime, cycle risk, and dealing with volatility. So for us, we will absolutely underwrite fantastic directional fundamental managers, but they'll hold a position for 10 years because they believe and they don't mind the vol. For us, we will exit that. We will rotate into a lower beta or a market completely neutral manager. And I think that when you look at that over the course of the cycle, then suddenly when these big drawdowns occur with a Bitcoin, you're mitigating a lot of that, and that's how it outperforms. So I think for a lot of groups, there's this tension that's seen as like, oh, it's mutually exclusive, but it shouldn't be seen that way. There's absolutely a space for active and passive in the portfolio.
Yeah, I like this a lot. I like thinking about it in this barbell approach, and maybe if I take it one slight step further, I see Bitcoin is truly the asset within digital assets that's found product market fit so far. Then we have stablecoins. Stablecoins has arrived now that we have the Genius Act, now that we have $300 billion in market cap, and you see all the competition there. And then we have this third bucket, which is kind of everything else, and we're still looking for this real product market fit across a number of different slivers. But in this technology, which will ultimately be the backbone of the global economy, we can see, Pierre, I love your number, 100 trillion in less than 10 years, right? If we get there, I mean, just think about that multiple from 4 trillion, 25x. That's an incredible tailwind that pulls, this almost a secular growth story of this asset class. So for me, when I think about differentiating managers who are trying to beat Bitcoin, if we're in this huge secular tailwind, there's a diseconomy of scale with Bitcoin. It can't keep doubling. But everything else, we only have one asset that's worth $1 trillion within digital assets. If we get to 100 trillion, we're going to have many. So there's, again, going back to that asymmetry, there's going to be an asymmetry for the liquid token managers to find those, those liquid venture-like returns. So that's really important to me to have a balanced portfolio. And the final thing I'll say, I love this secular growth story, right? This powerful beta, this tailwind. But on top of that, the thing that attracted me at the very beginning of my career, and is still very evident today, is that there's alpha to be had. So you get this beta, perhaps one of the best betas over the next decade, in addition to the alpha, and the alpha is there because there are a lot of because there aren't a lot of institutions here trading very, very professionally, because there are a lot of retail investors who have a penchant for leverage, because there's fragmentation, because it's a decentralized market infrastructure with 300 different exchanges all over the world. All of this leads to inefficiencies, and all of this leads to alpha. So to conclude, I mean, I see the beta story as powerful and the alpha story as powerful, and combining them together is perhaps one of the most powerful kind of investments you can find today.
For institutions who are entering the space, who are just sort of trying to figure out where to jump in, how would you? What are your views on fund-of-fund investment opportunities versus directly investing with individual GPs?
Yeah, maybe I'll go first. I would say that if you think about a little bit financial history and you look back to the 90s when this product was very popular in traditional finance, there was good reason for it. The space was very fragmented. Hedge fund managers took big bets, and there were blow-ups, but there was also huge returns. And the idea of paying a double fee layer, which has long been the criticism of fund-of-funds, was rendered mostly relevant because the performance was more than enough to offset that. And as the space has consolidated in New York City, you have a few, 12 massive funds with all the AUM. They make big management fees. They generally have very low vol, which means their returns are very low as well. And that product breaks down. In crypto, you see the same conditions as in the 90s. And I think for someone looking to get involved in the space, beyond just concentration risk, which is always the case when you're in one manager, even if they're a macro manager that pays attention to cycle risk, you still have the concentration risk. I think if you can find a group with scale that does the work well and has high liquidity, maybe they set up SMAs, they have relationships with managers where they're big LPs, so they have control over the accounts, they have transparency in the accounts, they don't have long redemption times. You can have agility, and that allows, in a high vol situation like this, movement among different managers. And so I think the same conditions are in place today, where you can have really, really high conviction managers, amazing performance. And yes, it's a double fee layer, but part of that also gives you protections and access that you wouldn't otherwise have. So I think it's a great way for institutions to think about making an expression into the asset class.
And Pierre, maybe I can add what I think is so funny in this space. In the hedge fund world, people love these big multi-managers, like the big Millenniums and the Citadels. But in fact, they're just internal fund-of-funds. There's also that extra layer of fees. Fund-of-funds almost need a rebranding to be an external multi-manager fund.
Yeah.
Right? So you are paying fees, but if the alpha is greater than those fees, you can only eat your net returns, right? So I think that is like a big point, and somehow you're exactly right. So Of course, I'm very biased because I run a fund of funds, so please take that with a grain of salt. But if we look at this weekend and we see the damage that happened, imagine you were a small endowment and foundation and you had mild conviction, right? You can't borrow conviction there, but you had mild conviction, you went into digital assets and you completely blew up. Your investment committee is saying, wow, we went to zero, right? So I think the very sophisticated digital asset investors will have many, many pods, and maybe they don't need this diversification across fund of funds. But we need diversification across strategies. We need diversification across ecosystems. We need diversification across exchanges, counterparties, service providers. Because the one thing that crypto has taught us is that there will be crises, and this is not the last one we're going to see. And the one free lunch in finance is the diversification. And I think if you can do it right, and you can truncate the left tail risk by having enough experience to know, the really obvious ones to avoid, I think you do get that free ride of like the tailwind. And yes, again, I'm biased, but I think that fund to fund is a very, very robust alpha that fits really well in portfolios.
Yeah, I think I agree with what Pierre and Chris has said. It's always a question about breadth and the edge. The edge will come from specific managers. So a bit like what we saw in the internet and the tech thing, not every fund is a Sequoia Capital or Andreessen Horowitz. But when you're at early stage, you have to have the breadth because everyone has similar risk. So you can use that to diversify in a fund of fund structure. You mentioned multi-strat fund, and where we see that on the equity side, how much they are building, struggling, and things are going on. So you always have that risk. I mean, there's huge optionality. You do not have to take very specific risk because the upsides are big, which means that you could lose all your capital on the downside if you get wrong. So I do think you have to have a combination of the breadth on the fund of fund side and edge if you like a very specific project or if you know a very specific manager. I like people who have had long experience in cycles of managing macro things, and then they're moving on the digital side because they bring that understanding of what can go wrong when interest rates change or the regime changes or the politics changes. So I think a very barbell approach like what Pierre mentioned initially is the good way to go if you are new to this asset class.
Absolutely, thank you. Do we have any questions? We have a minute left that we might be able to fill if anyone has anything to ask our allocators today. Anything else that any last thoughts then on where we're at now with institutional allocators' views on digital assets in 2025 and maybe views on 2026 and beyond, where you see sort of management of portfolios shifting next year?
So purely from what's happening in the market, I can tell you that I'm extremely bullish on what's happening in the global world. And you always keep hearing about bubbles and market crashes. The more skeptics you have, the more those things are not going to happen. Nobody talked about market crash in 1937 or 2007, and it happened. So I love when there's skepticism. You should really applaud the skeptics because that's good for your asset class, that's good for your business. It keeps the managers reined in, the founders reined in, the capital reined in. But if you take that away, and also on the rate cycle, where are we at this time? Fed is about to cut more rates. We saw some confirmation yesterday that they could be cutting rates twice. We still see GDP growth in US, which is absolutely stunning. So yes, you will have the fight between President Trump and President Xi over social media, but you can ignore that and look at the real GDP growth and how things are building up. So I feel extremely positive in what's happening, and which means that a lot of wealth is being generated. And when wealth is generated, it starts flowing into new projects. I mean, a lot of what we have seen today goes back to QE, when the capital became very cheap. And some of that will be destroyed, but a lot of that will also be used in a good way. So I feel extremely positive about where we are, and we have a lot of opportunities ahead.
I would just say really fast, I think the asset class deserves an allocation after all the history where we are with regulation and policy, market structure, participation. I think the answer is no longer zero.
Yeah. And my final thought truly is where we are with this monetary and fiscal debasement. We see gold at an all-time high. We see Bitcoin at an all-time high. the Fed is about to cut rates, add more liquidity. It's a setup for a revaluation of nominal assets. And as Bitcoiners like to say, it's not Bitcoin that's going up, it's the US dollar that's going down. It's fiat currencies that are going down. There will only ever be 21 million Bitcoin. And if that's your starting point, just investing in digital gold in Bitcoin, you could do a lot worse. But there's so much more to the asset class as well.
That's a great final thought. Please join me in thanking Chris, Pierre, and Manish.